Yeah, Hobart's performing very strongly, and so are Sydney and Melbourne, as they have been over the past nearly 5 years now. So the January results came out. We saw a 0.7% uplift in values across our combined capitals index. But once again, Sydney, Melbourne, Hobart were really leading the charge there. Sydney values are now up 16% the last 12 months. That's the strongest annual growth rate we've seen since September 2015. Melbourne's up by nearly 12%, Hobart's up by around about 8%. Every other capital city, actually over the past 12 months, apart from Perth and Darwin, has seen a capital gain. But Perth and Darwin, interestingly enough, the last quarter, the last 3 months ending January, have actually seen some subtle growth. So whether or not this is those markets moving through the bottom of their cycle is yet to be seen. But we have been seeing transaction numbers starting to lift off a very low base in those markets. We've been seeing some bottoming out of migration trends as well. So hopefully we are starting to see buyers recognizing some value in those markets. Yeah, the headline figures from the Pain and Gain show that the capital cities are generally still showing a relatively small proportion of loss-making sales outside of the weaker markets like Perth and Darwin, where loss-making sales were still trending higher. If you look at a market like Sydney, for example, it's still only about 2.5% of properties were selling at a loss. What we are noticing, though, is in the capital cities, we are seeing the loss-making sale trend of units starting to move higher, particularly in markets like Melbourne and Brisbane and also in Perth. But if you want to look at the worst case scenarios, those areas where we're seeing more than 50% of resales in a marketplace are loss-making, you can look to the mining regions. Areas like Mackay, Fitzroy, outback Western Australia, for example, are all seeing loss-making sales at more than half of the resales we saw over the latest December quarter. Well, unfortunately, there's no real magic bullet for improving or solving the housing affordability issue we're seeing at the moment. It really does require a multi-pronged and coordinated approach from all layers of government, federal, state, local, as well as the private sector. If you look at the supply response we've seen in the marketplace over recent years, we've seen unprecedented levels of housing supply hit the market, but arguably it's the wrong sort of supply to improve affordability. It's high-rise units, very much more centric to investors rather than owner-occupiers. We need to see more three-bedroom apartments in a medium density setting, more small lot housing located strategically that's efficiently linked by transport infrastructure. So at a time when population growth is still really strong, we really haven't seen an appropriate infrastructure plan that's connecting those outer fringe greenfield housing areas as well. So if you look at the measures of affordability, if you look at measures that are based on interest rates, they've actually improved over the past 8 years because mortgage rates are so low. But if you look at measures of affordability, such as the medium multiple to household incomes, absolutely that's worsened. In fact, we haven't seen affordability this severe in Sydney ever. We're seeing the typical dwelling value or dwelling price in Sydney is about 8.5 times higher than household incomes. House prices are about 10 times higher than household incomes in Sydney. So clearly quite an issue, particularly for first home buyers who are really struggling with the deposit hurdle to get into the market. That's right. APRA introduced the 10% speed limit for investment portfolio growth back at the end of 2014, and it took about a year for that target to be reached by the lenders. It takes a long time to turn around lending policy, of course. What we're seeing now, though, is that downturn in investment lending has absolutely bounced back. The last 6 months of 2016 saw investment every single month consistently starting to grow. It's still well and truly below that 10% speed limit in annual terms, but if you look at the last, say, 3 months or last 6 months, annualize it out, and it's likely that we'll start to see investment lending getting closer to that 10% limit that APRA set back in 2014. If we continue to see investment in the marketplace, which by the way now is about 49% of the value of all housing finance commitments, if we continue to see that rising, I wouldn't be surprised if there is some additional regulatory response from APRA. It could be higher capital requirements for lenders, which means mortgage rates will rise for investment purposes. It could be higher LVR requirements for investment. You may even see the banks, independent of any APRA changes, starting to tweak their own internal risk policies as they relate to investment.